Welcome to This Explainer. Today, we're cracking open MFRS 140 to figure out exactly how real estate should live on your balance sheet. Because whether you're holding land for the long haul or managing a massive skyscraper, how you classify it changes absolutely everything. So let's dive right in. Is that building an asset or is it an investment? It's literally the very first question you've got to ask when looking at a property. Getting this wrong doesn't just mean a tiny hiccup in your ledger. No way. It actively alters your entire financial reality and basically dictates how profitable your company appears on paper. Today's blueprint is highly logical. We'll be defining investment property, navigating the gray areas, looking at how to measure value, discussing transfers and derecognition, and wrapping up with the key MFRS 140 takeaways. Let's get to it. Section 1. Defining investment property and the rule of contrast. To truly wrap our heads around what an investment property actually is, we have to look at the rule of contrast. An investment property is exclusively land or a building held for rentals, capital appreciation, or both. And this is entirely distinct from properties you actively occupy, for production or administration, or properties you're just planning to sell as inventory in your ordinary course of business. This really brilliantly illustrates the intent required. Think about it. Whether you're holding vacant land just hoping for a market boom, holding land where you haven't even figured out the future use yet, or building a structure strictly meant for future tenants, your core objective is passive, long-term returns. If you've got a vacant building simply held to be leased out under an operating lease, boom, MFRS 140 applies. Now conversely, take a look at the exclusions. If you're acting as a developer constructing a property for a third party, or if you're moving your own admin team into the offices, making it owner-occupied, or leasing it out under a finance lease, well, it completely falls out of the MFRS 140 classification. Intent is absolutely everything here. Section 2, navigating the gray areas. We're talking dual-purpose buildings and services. Now, what's really interesting here is how we take these rigid rules and apply them to the messy, mixed-use reality of modern real estate. Imagine a dual-purpose building where you can legally sell the floors separately. In this case, it's actually quite clean. You just allocate the cost or carrying amount, say based on floor area, and split the building. The rented portion becomes investment property and the owner-used portion becomes standard property, plant, and equipment under MFRS 116. Easy, right? But what if those portions cannot be sold separately? Well, that's where we hit a critical threshold. If between 0 and 10% is owner-occupied, it's considered insignificant, and the whole thing stays in investment property. But cross that line to 11% or more, suddenly it's deemed significant, and that entire building gets reclassified as standard PPE. Let's put this into perspective with a practical example. Say you have a massive skyscraper, 20 floors total. You rent out 19 of them, but you occupy just one floor for your own administration team. 1 out of 20 is exactly 5%. Since that's well below our 11% threshold, your owner-occupied portion is insignificant, so the whole massive building remains firmly classified as an investment property. And it's not just physical space that complicates things. It's the services attached to it. If the services are insignificant and you simply rent out the property, you're fine. But ironically, the very act of providing significant owner-managed services, like having staff clean a hotel room or providing active security guards, that is enough to instantly transform your passive investment asset into regular owner-occupied property. Wild, right? Moving on to Section 3, how to measure value and put a number on the asset. So, the crucial point is, once we successfully navigate those gray areas and know for sure we have an investment property, how do we actually measure its financial worth? Well, initial measurement is always strictly at cost. This means future economic benefits have to be probable, and the cost can be measured reliably. You include the purchase price and directly attributable costs. Think legal fees, professional fees, property taxes. But listen to this carefully. You are strictly banned from capitalizing general startup costs, early operating losses before planned occupancy, or abnormal waste into the asset's value. Just don't do it. After that initial purchase, you face a massive accounting choice. Do you track the market with the fair value model, carrying it at fair value at the reporting date where every single gain or loss instantly hits your profit and loss statement? Or do you take the more traditional route with the cost model, slowly grinding the asset's value down over time through accumulated depreciation? This choice radically changes the volatility of your reported earnings. Now, if you're constructing the investment property yourself and you've elected to use the fair value model, you've got a specific 3-step journey. Step 1, while the cranes are moving and construction's happening, you measure it strictly at cost. Step 2, the exact moment it's completed, you remeasure it to its fair value. And Step 3, any difference between that construction cost and the new fair value, you immediately recognize that in profit or loss.
Section 4. Transfers and derecognition. Basically what happens when circumstances change.
The standard is absolutely relentless here. You cannot just shuffle assets between categories on a whim to make your balance sheet look a little better. A transfer to or from an investment property is allowed only when there is a genuine evidence-backed change in how the property is actually being utilized in the real world. If you're using the cost model, a transfer doesn't change your carrying amount. But if you're using the fair value model, things get pretty interesting. When moving an investment property to PPE or inventory, its fair value on that exact transfer date becomes your new deemed cost. The same goes for moving PPE into investment property. But if you take inventory and transfer it into an investment property, any difference between its carrying amount and its fair value must immediately be recognized in profit or loss. You are locking in the financial reality of that transition right then and there. Finally, derecognition. Honestly, this one is relatively straightforward. You wipe the asset from your books upon disposal or when it's permanently withdrawn from use and absolutely zero future economic benefits are expected. You calculate the net disposal proceeds, subtract your carrying amount, and record that ultimate gain or loss directly onto your income statement. Section 5, MFRS 14 Key Takeaways. Let's summarize the blueprint. This complete visual map derived from our source perfectly reinforces the entire journey we just took. Notice how focusing on the actual, verifiable purpose of holding the property acts as the compass. It drives every single accounting decision you make from day one. So, to distill everything down to its essence, your active intent dictates the category. Rental and capital appreciation, that equals investment property. Own use, that equals PPE. Held for sale, inventory. Choosing the fair value model means accepting profit volatility, since those remeasurements hit your profit and loss directly. And remember, you can never, ever reclassify an asset without a legitimate change in its real-world function. I'll leave you to ponder this final question as you review your own ledgers. In a wildly fluctuating real estate market, does utilizing the fair value model actually reveal a company's true wealth on a given day? Or are you just chasing a temporary illusion on your balance sheet? Think about how those swings impact the story your financials tell. Thanks for joining me on This Explainer, and keep questioning what's behind those numbers.